Hi, people. Thank you for stopping by at Building Wealth with Rajeev. Growth stocks are finally picking up, and it brought some smile to my face. I won't lie about it. By the looks of it, bulls might be back, but who knows? In the middle of all this drama, I had a very good chat with Stuart Sim. Stuart is a young lad from Melbourne, Australia. He has a great investment record. On top of it, he might just make it to Australia rowing team in Olympics. I began by asking him, how is he dealing with these choppy waters?
Seeing this widespread tech sell-off is somewhat concerning, but I actually feel a lot better than I did in March of last year, because I feel like in March last year there was, we were on the precipice of what would be a global pandemic killing hundreds of thousands of people, and I just didn't know how things were going to go. This March just seems more of a cyclical, sector-based rotation, if not correction, based on treasury yields, which I'm not a macro economist. I'm not looking at that kind of data and tracking that too closely. But the fundamentals of the businesses that I've tried to move into over the last year, let alone the last 7-8 years, really haven't changed in the last month. So while I'm down I'm probably down 10% year to date, for whatever that metric's worth. It's quite funny, arbitrary dates to start the year. I'm not actually too concerned. I was much more concerned in March of last year. This year, I can understand people want to take some profits out of tech and potentially rotate them into other cyclical stocks or reopening stocks. But personally, I'm not following that money movement. I'm going to stay inside of tech, even if they're down 30 to 40% off of their all-time highs.
Kind of agree with that. Thanks for sharing. Tell me, your portfolio, like you started investing about 5-6 years. How does it look like in terms of the upside?
Yeah. So I unfortunately am using an Australian broker, so it's kind of hard to measure my exact returns. But it's somewhere between a 450 and 700% return since about 2014. And that the difference between that is just how much paid in capital I've actually put in. And like I said, up until last year, I wasn't super diligent about tracking that. So yeah, right now, this has been a bit of a different month for me, but a month ago I had about 15 stocks in my portfolio, primarily tech. My biggest positions, I'll use my December kind of calculations, and then I'll fast forward to today. But my top couple of positions at the end of December were Amazon, Lemonade, Tesla, Facebook, Apple, CrowdStrike, Google, Nvidia. That represented about 82% of my portfolio. And then the remaining 8 stocks, which were mostly newer purchases post-pandemic, with the exception of Microsoft and Visa, represent the remaining 18%. So companies like Twilio, Elastic, Fastly, I did one SPAC, A1, things like that. Over the last month, given the correction that we've seen in tech, I have actually expanded into a couple new names, albeit at relatively small position sizing. But I fully expect new positions to be down 20 to 30%, in the first 6 months of myself opening them. I hope they don't, but they might inevitably trade sideways for 2 or 3 years before really having a dramatic upwards move. I think that's going to be the really interesting play. I mean, you look at Microsoft stock I'm pretty sure from 2000, even 2001, so post .com bubble, So 2001 to 2014, the S&P 500, and feel free to fact check me on this, but I'm pretty sure the S&P 500 outperformed Microsoft from 2001 to 2014, which is just ridiculous. Like you tell that to anyone, hey, what was a better performing asset for this 14-year period? It'd be so hard to not say Microsoft. But the reality is it went sideways for 14 years. And now it's, heralded as this golden stock over the last 5 years. So yeah, long story short, and this is the same thing with Fastly to some degree, is when I buy a stock, I'm going to be watching the trend, pretty closely over the first 2 or 3 quarters that I own the stock, because I want to be paying attention to what moves management is making, because I'm going to be trying to, I think you do have to be a contrarian investor to actually generate alpha. You can't, as much as I've just bought some of the hot names, I'm also buying them, 30 or 40% down off of their 2020 highs. If that's contrarian, who knows? That's up for debate. People will scream at me and go, "Oh, you're just momentum buying Zoom at $370." But you've got to have some contrarian. Like I told people, people were seeing me buy lemonade, at $46, and then all of a sudden it's 120, and everyone's going, "Oh my gosh, like, should I buy lemonade?" And I'm like, no, you shouldn't actually now. Like, the alpha's gone. It's I think you're coming into a very risky earnings period with lemonade. You can't, like, I don't really recommend any stocks to anyone, because it really matters on your personal situation and goals and everything. But at $120, yeah, I'm not recommending it. At Fastly, I'm not recommending it at $90. But yeah, Fastly is one of those story-driven ones for me, where it's you've got to be betting on the edge, not necessarily on CDN. Are people viewing it as CDN only? And if that's the case, then yeah, you probably could move into Cloudflare.
It's really interesting. No, what intrigues me, you're 28 now, and you probably would have started investing when you were 22 or 23.
Yeah, 21, 20.
Yeah, it's fairly young age to start. I mean, these days, I know, young people have more knowledge compared to the older one, because of the internet and things like that. How did you get started? That's really fascinating that you started investing in 21 and you've been so successful. What got you started?
It's pretty easy answer, which is my dad's a stockbroker.
Okay.
So these were dinner table conversations, through high school. Is that look, I say I started investing when I was 20, but that's really when I was actively in it. So I did pretty much my work money through high school. If I'm working at the supermarket or working at a rowing coach or as a bartender, I guess not in high school, but all of my summer jobs in high school, all of that money was already going towards the market. And then, so I knew kind of about buying and selling stocks. It was not any substantial money, but then, when I figured out how to, or when I got into college and I said, I'm going to take this more seriously, I did have a bit of history, but honestly, I would have thought of it more as the mindset rather than something too serious. I mean, but that said, even in college, I was a business undergrad doing some work in some private equity firms, some VC firms over summers. So that was just naturally, pretty interesting, where, I could see how, like, even today, my portfolio, to, my earlier point of how I categorize it, is somewhat VC based, where a venture capitalist or, angel investor has to make, 20 plus investments, and they hope that one of those investments just returns the fund. And if not, ultimately much more than the fund. and I do kind of take that into my stock picking and portfolio construction, which I just think is so not talked about. Like, you can pick the best stocks in the world, like I said, but if they're not correctly sized, they can either not deliver you sufficient returns to reward you for identifying that stock, like, let alone hurt you. And that's my VC mindset, is where the cool thing about the stock market is I'm hoping none of these go to zero. I mean, I've had one go to zero, 1 out of 28, went bankrupt. And then the rest are all pretty healthy returns, with companies like Tesla and Nvidia, where I've had, close to 2,000% unrealized gains on something like Tesla, which is pretty great for the public market.
Absolutely. I'm just curious to know, which one was your first stock?
My first stock was Apple. It was Apple, and it dropped 20% in the first 30 days, and I essentially doubled down on it. And then second stock, here I've got the list. So although not in order, it was Apple. LinkedIn was my second stock, got acquired by Microsoft. NXPI Semiconductors did reasonably pretty well. GTAT was the one that went bankrupt. I bought that at like $10. They were an iPhone screen supplier, and they were awarded this massive contract with Apple. I was in, stock went to $25, and then 1 quarter later, Apple started pulling out of the contract, and they just had invested all of their money and went bankrupt. Then Activision, I was a gamer growing up, loved that. Then Microsoft, Tesla were my next. Those were my first seven actual stocks.
And why did you buy Apple? I mean, was it your personal experience which made you feel good that this is a great product and it has got a lot of legs, or you did your due diligence in terms of financial statements, or?
Yeah, the way I kind of did it then is quite similar to how I'm still doing it today, albeit the probably later stages of the investment is different. All I knew that in 2013, 2014, what can I distinctly remember about Apple? One, I knew that it was a relatively safe bet. Like, this company wasn't going anywhere. It was a technology company, and I had just moved to America, or maybe I was 1 year into living in America in Seattle. It's not San Francisco, but it's obviously got Microsoft and Amazon, Boeing, and a couple of, so I just saw this huge wave of technology companies just really expanding. And what I've come back to recently, but specifically with Apple, I just knew that I was bullish on tech, and their cash was just mind blowing. I think, even back then, there was,
solution has always been very good.
yeah, exactly. So I was like, look, if these guys, my dream was for Apple to buy Tesla. I was just like, there's even this one video actually, which was like a TED talk or something from 2012, where I remember this one guy was like, every company, and this is 2012, should become a media company and a brand. Like, every company should just be a brand company. And Apple, I was like, okay, I can see a world where Apple has Apple cars, Apple t-shirts, Apple desks. Like, Apple should just essentially, could go down the Disney, licensing model, and, or, bring it in-house or whatever, but they really can theoretically just expand into just so many different product verticals. So that's what I really liked about Apple. I knew they were profitable. I can read a balance sheet as a business undergrad, but I wasn't doing any. I can tell you right now, I didn't look at their PE ratio or any ratios of any kind realistically.
So even while now investing in Lemonade or Fastly, I mean, you didn't look at these ratios. You're just looking at the company's narrative and the future.
First step is narrative. Second step now is a more technical or fundamental driven. I wouldn't say even fund. I guess more due diligence on the balance sheet. I'm still not looking at it at a pure fundamental levels, but that obviously reaches a point. Like if I'm looking at, hey, Lemonade's an interesting example because I think it is a differentiated company, but something like inside the kind of data and security space, whether it's CrowdStrike, Datadog, Cloudflare, looking at and understanding those multiples, I think does play into it. And that was something with Zoom even recently, in October or November, when Zoom was at the $550 mark, I was quite excited at the cash flow and the platform. So the narrative for me was, okay, Zoom is now showing signs that they could be the #1 video and communication platform for the future. It's gone from a product to a platform. So narrative checked. Next part of due diligence. Okay, free cash flow, growth, cash on hand. What's their going concern ability? Long-term debt. How much of their expenses are stock compensation and cash movements, things like that. Basic balance sheet. Okay, very healthy. Check. Okay, third thing, fundamental valuations. Okay, trading at 65 times sales. And I was like, yeah, that to me, I'm happy to be aggressive, but 65, I can probably, that's probably a bit stretched. So yeah, something like Snowflake, Palantir, like two very interesting names for me that I'm definitely scared at their valuations. And yeah, likewise Lemonade. I was like, anything like, even when I was doing my last buy at $90, I was like, this is enough. And anything above this is too much in terms of valuations. Okay. But I would say my last thing with that is, I think this is all changing. I think, you've got Microsoft, which I think is trading at like 9 times sales. I think the new market, a 2021 and beyond market, I wouldn't be surprised if these multiples just generally on average become higher for longer. So what that exact number is and how high is up for debate.
Yeah, I kind of agree with you, because what I've been noticing as well, that there's a lot of private market mindset which is coming to public market, where people are willing to pay premium for innovation, for a company which is trying to change things. So those historical ratios, they are kind of becoming less important, and especially if people are growth investors, they're not going to look at the historical ratios anymore. Looking at more of the forward-looking, what this company can bring in next 10 years, next 8 years.
Yeah,
something like that.
I think what's interesting is people pick and choose, and that's where I get a bit nervous, or try to point out a bit of that hypocrisy. Like, if you go, okay, I'm gonna say Lemonade is a great company because it's got 1 million customers faster than any other insurance company ever in the US, fastest to 1 million. Well, that's great, to the Lemonade holders, to the real Lemonade bulls, they say fastest to ever, but then they'll say, but it's not okay that it trades at 60 times earnings or 60 times sales. And it's like, okay, well, which one is it? Is it actually high growth and innovative? In which case, then yeah, it can sit at that valuation. But you don't, to your point, you can't expect a new high growth company which is, again, I'm only 7 or 8 years into investing, like was Microsoft a high growth company in the early 2000s and had different valuations? I'm not that old and experienced, but yeah, I totally agree.
No, I get it. And tell me, when do you sell a company?
Right now, my goal is to not sell while my top level thesis is intact. So I'll use what's a good example? I'll say Peloton.
Mm-hmm.
So Peloton's a new company. So what would cause me to sell Peloton in the next 3 quarters? It's not going to be price. Peloton can drop down for arbitrary reasons. Let's say my cost basis is 110.
Like right now.
Yeah, let's say it drops down to $50 or $40. I'm probably not going to sell it unless, one, for tax reasons. So if I want a tax deduction, then the easiest thing for me to do is just sell a stock which I've got a losing position on, and claim a tax deduction. So that's a great reason to sell for me. The second reason would be if the original thesis that I had to owning that stock is broken. So let's say Peloton goes, hey, we're not going to focus on international expansion. And that's really not a thesis of me. The real thesis for Peloton was going to be continued growth through acquisitions and this idea of essentially becoming a content platform.
Mm-hmm.
So they just had an acquisition, which was with Precor, which was a equipment manufacturer. Mm-hmm. And to me, yeah, look, great that it was an acquisition. I would have actually probably, personally loved it if it was a technology acquisition to show signaling they were going into, continuing to expand on their technology. But let's say the next 3 acquisitions of Peloton are all fitness manufacturing companies, then I'll be like, you know what? They're not actually moving into where I. That was why I sold completely out of Snapchat, literally 6 months too early. I bought Snapchat. It was right around when Roku was maybe 6 months after Roku, who had IPO'd. And I was like, okay, I think Snapchat is the company that is the only one that can actually beat Roku, and they've got a head start, and they should be the platform which all general traditional cable media should ultimately just transition to Snapchat, and Snapchat becomes the new TV. And they're going to do augmented reality and virtual reality, and you're going to be able to, pick up your phone and open up Snapchat and just flick it up onto the wall, and your Snapchat's now on the wall or, lifting up out of the ground. And I was like, that's where I think the future is going. Snapchat is the best company that I've seen able to execute on this. And then for 2 years, they did nothing. And I was like, okay, you are no longer, I just can't see any signals as to you guys executing on what I thought the vision for this company was. 6 months later, they release a fantastic developer SDK and just completely new strategy of how they want to execute as a camera company over the next 5 to 10 years. And I've gone, okay, that was a mistake. So long story short, I sell when the thesis is broken. I don't sell based on fundamentals, valuations. I did a bit with Tesla. I trimmed that, but I'm not going to sell completely out. Like I said, I was questioning, hey, Tesla.
Can it be 10 bagger or?
Exactly. So.
Okay, just tell me, I think couple of more questions and then we're done. One thing is you talked about portfolio, that it's not just about having the best companies in the portfolio, it's about creating a portfolio. And what did you mean by that?
Yeah, so the creating of the portfolio is what I kind of think about with this idea of the core growth, core value, and 10x. So let's say as I move into this next chapter of my life, depending on whether I think is the market generally bullish or is it generally bearish, and am I trying to create wealth or preserve wealth? That's going to figure out where I put what stocks I add to, or which basket of those three. So it's not necessarily specifically about Lemonade, but maybe I'll go, hey, okay, I'm feeling like I can take on a bit more risk. Lemonade is a bit overvalued. That's in my 10x. 10x is currently worth 32% of my portfolio. I want to push that to 40%. Okay, cool. I'm going to go to my watch list and, okay, do I buy Magnite? Do I buy whatever?
Okay, no, I get it. So there is a certain percentage you allocate depending on the life stage and the need you have, which is pretty good. Now, I think let's talk Lemonade. Do you have, I mean, this quarter results which have come out of Lemonade, I saw the CEO was pretty bullish. He came on CNBC and he said a lot of positive things about his company. But if you look at the growth rates, I wasn't particularly very impressed about it. So what are you thinking on that company?
I'm not too concerned about it. I think every time I listen to the CEO Daniel, I'm very bullish on the stock. I just, considering what we talked about, and market cap for me is just one of my, is one of the first things.
That's a starting point.
I'm really looking at, and I'm like, okay, this in terms of branding, which I mentioned that was what got me into Apple. I like brands. Brands have sustained power. I like technology companies. This is so new. The counter positioning of Lemonade as an anti-insurance company was just phenomenal. Like, the story is just so well pieced together. And then you look at the economics, like we said, okay, yeah, there are some growth issues. If 30 to 50% growth is an issue, like I think that's still appropriate growth rates for where they're at. They're still almost too early, right? They've got their product mix is, while it's growing, I bought it specifically when it was just renters insurance, and everyone's complaining that renters insurance is this tiny market, and I'm like, that's great. I don't want to buy it when it's in every vertical, because all the upside has already been priced in. So, look, I think it's great that they're expanding their verticals. I think they're even being forced to do it quicker than they want. I think they're going to keep it. I think, based on what I see in my read on Daniel, is that he'd prefer not to, release auto insurance, but they're going to be pushed to that before, what is it, Metro Mile and Root, all of these companies do it. So yeah, growth rates I'm not too concerned with. Their gross written, I think their in-force premiums are expanding. So I think it's like $220 per customer, as opposed to $190 last quarter, which is pretty good growth for a quarter to quarter, let alone year over year, which I'm sure a year ago, we don't have these exact numbers, I don't think. So all of the trends from Lemonade, to me, are positive.
Okay.
The steepness of these trends is clearly concerning to some, and this was almost, actually, ironically, one of my concerns was this became a TikTok stock right after I bought it. And I was like, okay, this could actually hurt the stock in the long run, because it's going to get run up and then it's going to get dropped, and everyone's going to think it's a dog, when in reality it's not a dog. So I would have preferred that it actually didn't go up to $180, because now are people going to go, oh, that's Lemonade, they've shown that they're capable of dropping 50 or 60%. I was hoping that it was going to be like, $120 stock at the end of the year with no massive jumps in between. I just wanted it to chug along.
Okay, so the last question, I think, any particular company you're looking right now for a fresh investment?
Fresh investment is tough. I think for me, the one that is is kind of starting to bubble would be magnite, which I've
Okay.
kind of mentioned. I just started a position in the trade desk, and
Okay.
I see them as relatively complementary companies from my pretty limited understanding of ad tech. So again, that would be kind of the trade desk. Sorry, that would be my 10x bucket.
Okay.
Honestly, part of me wants to push harder into Microsoft. The Microsoft just continues to amaze me in terms of what they're able to produce. And I'd love, and they've especially inside of their acquisitions, I would love for them to acquire something like Figma or Discord, but specifically Figma. Any company that buys Figma, I'd love to get into.
Okay. Cool. I think that's it, Stuart. I think it was lovely chatting with you, and I think you're pretty much very matured for your age. You've accomplished quite a bit by 28. I mean, you've generated these hyper returns, and you're being part of the Olympics team for Australia. I mean, it's something extraordinary. So very well done, and thanks for giving me time.
Thanks, Raj. Enjoyed the conversation and good luck.
Hi, people. Thank you for watching the video. I hope you find the content useful. If you like the content, please share, like, and subscribe to the video channel. And you may want to press that bell icon there so that you know as soon as I post something. In the meantime, keep smiling, keep hustling, and keep building.